Welcome to Trends with Benefits, a podcast by VanEck with a forward-looking perspective. We explore new ways of thinking about the markets, investing, work, and life. Here's your host, Ed Lopez.
Welcome to another episode of Trends with Benefits. I am that Ed Lopez, and my very special guest today is Dr. Ed Yardeni, President and Chief Investment Strategist at Yardeni Research. Dr. Ed, thank you for joining me today. I really appreciate your time.
My pleasure.
Now, you've spent decades on Wall Street. You were chief economist for E.F. Hutton, Prudential Securities, C.J. Lawrence, and investment strategist at Deutsche Bank Securities. Can we talk a little bit about your background, how you got started in the business?
Sure. It sounds like I can't keep a job though when you read when you list all the places I've worked at. But I started in the late 70s at the Federal Reserve Bank of New York. I was there for about a year, and then I moved down to Wall Street, starting out with E.F. Hutton. I thought I'd stay there for the rest of my life, and I was wondering why so many people at the firm had resumes that showed that they had worked at so many different places, and that's the kind of resume I have now. I guess it's the nature of working on Wall Street that you either leave voluntarily or the firms go out of business. So one way or the other, I've been on Wall Street, and ever since 2007, I decided to go off on my own. So Yardeni Research is my company. It's a small virtual company. Actually, now everybody's kind of got the same business model as we have, working from home. It's been a great experience.
Have there been any changes with COVID and how your business operates? Maybe you're not traveling as much as you probably did.
Well, as I said, we've been virtual. We haven't had any corporate business office anywhere. Everybody's been working from home since 2007 or from wherever they like. One of our employees likes to go to Spain to visit relatives in the summer for a few months. So we've been virtual, but accounts expected me to go out and visit them, and I enjoyed doing it because if I stayed home the whole time, I get cabin fever the way we all are these days. So I travel a fair amount to visit accounts, enjoyed the interaction that way. But now that's not happening. I'm not traveling, and everybody's gotten used to the idea of doing these Zoom video conference calls. It saves a lot of money, but on the other hand, I do miss the interaction of actually going out to visit people.
Yeah. I don't know about you. I find myself on these Zoom conference calls all day long and end up working longer days, I feel, than I did when I was in the office.
Yeah. Well, look, we don't have that commute anymore. I'm out in Long Island, and to go to New York City used to be an hour. Now it's more like an hour and a half to 2 hours. And that was before the virus hit. And now that people are back on the road again, the traffic is just as bad, I guess, because people don't want to take public transportation. So there's a lot to be said for working from home. But as I said, we're all getting cabin fever. I'm not a virologist, but I do know we're all getting cabin fever. And maybe that's one of the reasons that I think we'll see the economy come out of this surprisingly well once we all start moving out of our cabins.
Now, you've written a number of books that I think are fascinating, and the most recent one is Fed Watching for Fun and Profit that I guess was published or released in March of this year, of 2020. I enjoyed predicting markets, and partly because you talk about your history on Wall Street, and I found fascinating that you started at the New York Fed in, I guess, essentially under Volcker. And so you've had that experience there. And I wondered how this year, as crazy as it's been so far with a pandemic, interesting Fed policies, if you will, perhaps experiments, how this rates in context to your experiences, in particular with under Volcker.
Well, Volcker was really a great Fed chair. He was completely focused on doing right by monetary policy in terms of keeping inflation down, or at least bringing inflation down. That was really his big achievement. Inflation was out of control in the late 70s when he came in. And the stock market had a rough go of it in the early 80s because of his policies. But back then, he was focused on bringing inflation down. He wasn't at all concerned about doing right by investors in the equity market. That's changed pretty dramatically ever since Volcker left the scene and was replaced by three PhD economists, starting out with Alan Greenspan, then Ben Bernanke, then Janet Yellen, and now we have Jerome Powell. He doesn't have a PhD, but he's been around PhD economists for so long, it's kind of rubbed off on him. But the approach of these Fed policymakers ever since Volcker left has been to manage the business cycle, to try to moderate it, to bring inflation down and keep unemployment extremely low. And they've more or less succeeded on average, but every now and then we've seen some real problems, like the 2008 great financial crisis. And now there's a lot of issues that we're confronting in the financial arena because of the great virus crisis. So it's been a dramatic regime change between the kind of policies we'd had under Volcker and the policies we've had since then. And there are a lot of consequences of all that we can discuss along the way here.
Do you think from an intellectual standpoint, this is an interesting year, or is it like any other year with any other Fed governor?
No, this is a fascinating year. I mean, it's living through history for sure. I mean, as you said, I wrote that book on Fed watching. I kind of regret that I didn't call it "Don't Fight the Fed," because that really is the gist of the book. And I understand there's a lot of people Google searching that phrase, but the book is doing pretty well because the Fed obviously matters a lot. But the book ends at the end of 2019, and I'm already starting to write another chapter of the book. And I could, just in the past few months, I have almost an entire book on how the Fed has responded to the great virus crisis and what the implications might be. So, it's writing about history as it happens.
Yeah, I've noted one of the things you've talked about in terms of watching the Fed, which is, and you kind of referred to it in terms of don't fight the Fed. You also don't try not to criticize what they should do or talk about what they should do. You tend to focus on what they are doing, which I found interesting.
Well, it's kind of what I've learned over the past 40 plus years is that if you're going to be an investor, you have to try to be as objective as possible. And you have to focus on what policymakers are doing. Too many people, I think, are preachers. They're judgmental. Is the Fed doing the right thing or the wrong thing? Is kind of good or bad. And I kind of point out that while I'm a moral person and I have my moral views and philosophies, investing really isn't about good or bad. It's about bullish or bearish. As a result, I try to stay as objective as possible. And not criticize the Fed too often. I have my views on what the Fed's doing right and wrong, and occasionally I let that spill. I can't constrain myself, but my main focus has to be on staying objective. Given my day job is to provide investment strategy support for investors.
And you've been fairly successful at predicting markets, if you will, and you've written about your approach. Current analysis. What is current analysis, and how is that different than what most people are taught?
Well, I think most people really are taught to start out with theoretical models of how the economy operates or should operate, and then after the fact, they look at the data, and more often than not, they tend to pick the data that supports their model of how the world should work. Current analysis is really all about getting your hands dirty in the data. It's really about getting to understand the data series, to know what the data is saying. A lot of people use data without really reading the footnotes or the original source that has all sorts of warnings about what the downside might be of coming to certain conclusions about the data. The other thing is when you look at a lot of data, you realize that there are different series from different sources, and very often you can cross-check them with one another. So I try not to, not to be too judgmental in terms of judging policymakers, and I try not to get into the morass of falling in love with models of how the world is or should be, and really start out with a very, very realistic view based on the data. So I'm very empirically oriented. The Fed has used the expression data dependent in what they claim runs their policies. And that certainly is my approach to looking at the economy.
So talking about Fed watching, can we talk a little bit about the change in policy over the decades and how the Fed has changed the way it's operated? it seemed notable. We'll start with Volcker. It seemed notable that he became a monetarist in order to solve a problem, but that wasn't necessarily his style. And it seems like this Fed, and you move forward to today, this Fed is trying some new things as well. It seems like Fed chairs have to be flexible and try different things for different scenarios.
Well, I think with regards to Volcker, he was not a PhD economist. He didn't approach monetary policy with sort of a preconceived view of how the world works based on models. He certainly wasn't a Keynesian, and he wasn't really a monetarist. And when he adapted monetarist operating procedures in the late 70s, it was really more an opportunistic way to use that approach to let interest rates go to whatever level was necessary to break the back of inflation, which also caused a recession. So he was a monetarist for a very short period of time. It was very opportunistic in terms of what he was actually trying to accomplish. Was to raise interest rates without anybody criticizing him. So I said, okay, I'm a monetarist today. And when that led to a very severe recession and it actually did break the back of inflation, that's when he said, well, we tried it. It worked for a while, and now we're not going to stick with that kind of approach. Since then, models have been much more important to Fed policymakers. Although many of them are actually trained in Keynesian economics, they all seem to have bought into Milton Friedman's notion that inflation is always and everywhere a monetary phenomenon. So they've really had a very strong conceit, I would say, that monetary policy is all powerful when it comes to driving inflation, which hasn't been the case at all for at least 10 years. And I think they've just had this view that monetary policy is the only game in town because the fiscal side is just so politicized. It's hard to get fiscal policy to do anything. So they felt that it's up to them to really manage the business cycle. Their approach to that is based on law. They keep saying that by law they have a dual mandate, and that was the Humphrey Hawkins legislation of 1978, where by law they are required to try to moderate the business cycle with low inflation and low unemployment. They never seem to be able to admit that maybe they can't do everything and they can't keep doing everything. What they're doing is continuing to act as though they have all the power in the world to just fix things.
Did that interpretation of managing to the dual mandate change at some point in the last several decades or since Volcker?
Well, yeah, I mean, Volcker didn't have the dual mandate by law. It was really in the late 70s that the Fed was apparently restrained by the law to manage the business cycle. But, for example, in 2010, when the federal funds rate got down to zero, Bernanke and other Fed officials could have said, folks, that's all we can do. We can't, lower interest rates below zero. Doesn't make any sense. And instead, they said, no, we've run on our econometric model, and the model says that the federal funds rate should be minus 50 basis points to minus 75 basis points. And they said, well, they didn't even at that point consider negative interest rates, which has become something that actually has occurred in Europe and Japan, but so far it hasn't happened here. But their approach was we could do so-called quantitative easing. We could buy a lot of treasuries and a lot of mortgage-backed securities to the tunes of hundreds of billions of dollars. And again, they said our model says that's equivalent to having a negative interest rate. So there they go again with their econometric model, coming up with their view of how the world should be and using that as an explanation for why they did all this quantitative easing.
And the goal seems to be to try to stimulate inflation, among other things, I imagine. But they've not been quite successful at that, no. Right? Yeah.
Well, I think, again, if you try to view things empirically and start with the data and then work backwards to how the world works, I think the data demonstrates that we've had an amazing experiment, monetarist experiment, and tremendous liquidity provided by the Fed, but also the other central banks. And we've been doing that since the great financial crisis in 2008. And yet, where's inflation? Well, it's still under 2%, which is the target the Fed's had since 2012. still below 2% in the U.S., still below that 2% target in the European Monetary Union, which is run by the ECB, the European Central Bank. But the bottom line is that the data continues to show that even with all this tremendous stimulus we've had, central bankers have not had the kind of control on inflation that they thought they could. Fortunately, though, the issue isn't about bringing inflation down from some uncontrollable level pace, but rather trying to get it up to closer to 2%. But I don't really see why they're so bent out of shape about inflation being so low. For most people, low inflation is a good thing. And the fact of the matter is wages have been actually rising faster than prices in the United States since the mid-1990s. You wouldn't know that from the political conversation out there, but that's the reality is real wages have been going up. And again, that gets us into a whole messy area of economic data because there's lots of people who are convinced that that's just not the case.
What would you look for to warn others, or what should people be looking for in terms to see, okay, inflation might be coming? Is it deglobalization? Is it more wage pressure?
Look, I think first and foremost, we have to watch the data. And the data so far, especially in the midst of this great virus crisis, is still showing very low inflation and some deflationary tendencies. Certainly hotel rooms, airline fares. I mean, so all the areas have been so hard hit by the great virus crisis, they have absolutely no pricing power whatsoever and are facing deflationary pressures. But we will come out of this. And as we come out of this, it's conceivable that there could be at least a short-term transitory inflation problem where inflation doesn't go to double digits, but maybe it goes finally over 2%, maybe it's 4 or 5%. I think the Fed would actually welcome that and saying, we've been trying to get it over 2% for over 10 years, and now we're finally doing it. And we think that having inflation above target is kind of catch up. It's kind of a makeup strategy. And they would probably welcome more pricing flexibility to the upside as a way to stimulate supply, which means hiring people and producing more. And that at some point will then bring inflationary pressures back down. I think for investors, that could be a worry, and maybe it's a good reason not to be buying bonds when the 10-year bond yield is yielding less than 1%. Doesn't really give you much cushion in the event that inflation doesn't make at least a transitory comeback. There are people worrying about Weimar, just a hyperinflation. We've never, for 10 years, we thought we've never done anything like this in terms of ultra easy monetary policies. And now we're doing unimaginable things in terms of the amount of liquidity being poured into the U.S. and global financial system. And at some point that could lead to a hyperinflation scenario. I don't think it will. I think the other alternative is something more like Japan, where the Japanese have been trying to stimulate their economy because of their demographic profile, because of the technological innovations. They're not getting much price inflation out of it for consumer goods. I think where the risk isn't so much on the inflation of goods and services, it's on the inflation of asset prices. It's just hard to imagine that you can just pump in all this liquidity into an economy that right now is struggling because of the great virus crisis. But when it comes out of it, we'll still be struggling with some aftershocks from the great virus crisis. But so much liquidity has got to go someplace. And we since March 23rd of 2020, this year, we've seen exactly where a lot of it went. It went straight into the stock market with a 40% melt up in the market. That could continue. Imagine if the economy continues to recover, which we're seeing signs of, that might get set back by some of the setbacks we're seeing on the number of cases in places like Texas and Arizona. The fact of the matter is, based on what the Fed did in late March, providing what I call QE forever, the amount of liquidity that's out there and their commitment to keeping interest rates near zero makes bonds pretty uninteresting and just has created a tremendous rebalancing out of bonds and into stocks. And it happened so fast at the end of March and April that a lot of investors never had a chance to really think about it or act upon it. And so I think that kind of limits the downside for the stock market, and it does create a potential for the market to move higher. So I think there's more potential for inflation in asset prices even from here.
Maybe we can talk just a little bit about growth and value. I saw a recent video that you did talking about the trends and growth versus value. Growth has been on a tear. Will value stocks ever make a comeback? And are they actually mirrors of one another like they used to be? It seems like they used to be kind of more mirrors of one another, and there would be a switch, but that hasn't happened in the last decade or so.
I'm not a real big fan of the growth versus value concept. I much rather look at sectors and industries. I don't do individual companies. That's just not what we do. We're kind of top down, but we do, we do go down to the level of sectors and industries. And I much prefer looking at it that way. I mean, when you talk about value, I guess these days you're talking about energy and you're talking about financials, and there are opportunities there, especially for getting some good dividend yield to the extent that they've underperformed relative to growth, and growth that's paying dividends certainly is not cheap. But something like almost a quarter of the market capitalization of the S&P 500 now is those six magnificent six stocks in the tech world. Some of them are, Amazon's not tech, but it is tech, and Netflix isn't tech, but it is tech. But we're talking about the FAANGMs. That's where the imbalance has been, is you've seen a tremendous increase in the market capitalization. It does make me feel uncomfortable when I look at a chart of the S&P 500 growth divided by the S&P 500 value segments, because it's just straight up and it's blown through the previous high we made in 1999. When I see a chart like that, my instincts are to want to short it. Growth is scarce. It's hard to find companies that are able to grow. And the amazing thing is to find large companies that are able to maintain this kind of growth. And they're doing it. I guess there could be the big risk, of course, is that regulations will come into play. Governments love big, successful companies. They tend to want to regulate them, and by threatening them with regulation, guess what? They get a lot of contributions to their politicians. So it's kind of it's the way crony capitalism plays out, and there's a good part of crony capitalism that's, I don't want to use the word good. There's been a part of our economy that's been running with crony capitalism, which means bigger government and bigger businesses that cooperate with one another. But fortunately, there's also a very dynamic entrepreneurial capitalism sector in our economy.
By the way, I love reading how you talked about crony capitalism and entrepreneurial capitalism, and your definition was of entrepreneurial capitalism as the most moral, honest, altruistic economic system. I thought it was a beautiful description of what real capitalism should be. And just to go back a little bit, as you were talking about the growth versus value and some of the bigger companies seeing earnings, seeing growth, seeing price appreciation, if buybacks aren't necessarily contributing to increase in stock prices, what else do you think is?
Everything else.
Everything else.
Therefore, it follows, right? As I said, I started out in this bull market erroneously concluding that the buybacks were driving the market up. And then a couple of years ago, we kind of revisited this. There's just didn't add up with the small difference between earnings per share and total earnings growth rates. And so the only conclusion you can come up with, since it's hard to find any compelling data that shows that, it's retail or it's institutional or it's foreigners, it seems to be all of the above. It's people buying ETFs, and that could be individuals in the U.S., institutions in the U.S., could be foreigners. It could be rebalancers, pension funds, insurance companies saying, bonds just aren't going to do it for us anymore. We got to change our weighting away from bonds and buy more stocks. So I think there's been a lot of rebalancing going on during the bull market as bond yields have come down. Everybody kept talking about TINA. There is no alternative to stocks during this bull market, which I'm saying started in 2009. But there was. Bonds did extremely well up until they got down below 1% just recently. But now with bond yields so low, there's clearly a lot of people saying we've got to rethink about what is a balanced portfolio in terms of the weights of stocks versus bonds, and increasingly that means more stocks.
I was thinking about your autobiography, Predicting Markets. Did you keep a journal throughout your years? Did you have to go back and kind of piece things together?
That's my bookcase in the back there, and back in the old days before PCs, we used to send these things out to the printer, and we used to have drafts people who put together the charts, and it would take at least a week to put out a weekly, so it was already dated. And so I have all of the hard copies of everything I wrote in the 80s and 90s. That I kind of put them together in books. But ever since the mid 1990s, we've had PDF files. When I sat down to write my professional autobiography, it took me a year and a half, and I told myself I wasn't going to do any original research. It's all going to be based on the lessons that I've learned based on what I've been doing. Fortunately, it's not over. As I said, I'm already working on another chapter on the Fed. Another book I'd love to write is exactly on crony capitalism versus entrepreneurial capitalism. So I got a lot of ideas for more books, if you will. Never a dull moment in this business.
So, your whole history is built on trying to predict trends. What is one trend you see playing out over the next year or several years?
One of the things I've observed is that economists never seem to really appreciate how technology evolves and how it solves problems and can change things radically relative to what our forecasts are. I think technological disruption is a big part of the story of the future here. And again, you don't need me to tell you that major changes are already occurring in the auto sector, in robotics and artificial intelligence. These are all already having an impact. And by the way, getting through this great virus crisis would have been a lot more difficult for many of us who couldn't do what we're doing, which is working from home using Zoom technology and so on. But another very important trend, which kind of is related in some ways, is demography. I'm a big fan of trying to understand demographic trends. There's a tendency to believe that these things happen so slowly that they're not kind of very relevant, but demography does catch up with you. Age catches up with you. What I've observed is that in recent decades, fertility rates have plunged below replacement everywhere except India and Africa. And they've done it because of urbanization. People just aren't having kids. And as a result, because we're living longer, populations are aging. And the poster child for that kind of world is Japan. It's been there for many years. An aging population using technological innovation to maintain a relatively good standard of living on a per capita basis without much inflation and with some crazy fiscal and monetary policies that haven't led to a calamity. And maybe that's sort of the path we're going down.
Then finally, we do our speed round, which is trend or fad. I'll mention a few different concepts, and you can tell me if it's a trend or fad in your opinion. Bitcoin, trend or fad?
Fad.
Elon Musk, trend or fad?
Trend.
Modern monetary theory, trend or fad?
Both.
And home fitness, trend or fad?
Trend.
Dr. Yardeni, thank you very much for your time today. I really appreciate the discussion. What's the best way to follow you? Go to your website, yardeni.com.
Yeah, yardeni.com, yardeni.com. There's a blog.yardeni.com is open to the public. So those are some ways to keep in touch with me.
Thank you very much.
Thank you.
And thank you very much for tuning in to another episode of Trends with Benefits.